Hello and welcome to interest.co.nz. I'm Janae Tibshirani and today I'm joined by the Auckland-based tax consultant Terry Baucher. Good to have you here, Terry.
Thank you, nice to be here.
We're catching up today further to Terry launching a new book, Tax and Fairness, which he has co-authored with the Massey University lecturer Deborah Russell, who is just getting into politics with the Labour Party. Deborah has also worked with the IRD. The book, Terry, comes at a really sort of pertinent time. The IMF on Tuesday released a massive report that it's been doing on New Zealand's financial system, and it said that further tax measures related to housing could be considered to reduce incentives for leveraged real estate investments by households. It says that such measures could help redirect savings to other potentially more productive investments. So here we have the IMF saying that we could sort of introduce new measures to sort of better spread our investments. What role do you think the tax system has played in the imbalance that the IMF says we currently have?
Quite a significant role down the years. It probably one of the critical weaknesses that's been identified by the IMF and the OECD is the lack of a capital gains tax. And that has been also identified recently by, well, not specifically by Dr. Andrew Coleman from Motu Economics, when he was talking about the effect of tax has had on the housing market and how changes in the tax system in 1988-89 basically gave a huge incentive to invest in untaxed real estate rather than in superannuation and overseas. These imbalances have been in the system for quite a number of number of years now. The OECD, for example, identified a problem in 2000 with overinvestment in housing relative to other countries in the OECD. And the McLeod tax review the following year actually estimated that overinvestment, if memory serves right, it's in the book, $40 billion by 2001 dollars. Our housing market has dramatically, house price inflation in New Zealand is dramatic even by world standards. Our Reserve Bank of New Zealand has estimated that the value of residential housing in New Zealand went from about 25 billion in 1980 to 1 trillion by the end of 2016, way in excess of inflation.
And that 1 trillion as well is almost 9 times greater than the value of New Zealand listed stocks.
Yes, and that's
9 times.
9 times, and that's actually highly significant because most modern economies, the value of the stock market is really relatively high, is usually close to or above GDP, whereas in New Zealand it's barely 50% of GDP. It's not even 50% of GDP. So we have this massive imbalance in our savings, and this is an issue we look at in the book as to what's happened here and what is it in the tax system that has produced these imbalances and what are the effects of it.
Okay, and some of these tax settings have been made in the 80s.
Yes.
And do you feel like they're sort of coming to an head now? Or has it been a long time coming?
It is a long time coming, but the thing about the 80s is a massive amount of change with the Rogernomics period happened across the whole of the New Zealand economy. It also happened in the tax system, which was completely overhauled in a very short period of time. And there's a fantastic amount of hard work went in at that period. Some really heavy hitters got to work on what do we want from a tax system, and we looked at the policy wonks at the time really wanted to eliminate all distortions in the system so that people made investments on investment grounds, and the tax was minimized as a factor. Tax is always accepted as it causes some distortionary effects, but the policy behind, the overriding policy behind the 1988, the 19 reforms in the 80s was to remove all those distortions so that every investment could be judged on its investment merits and no asset class was preferred over another.
Yeah.
The problem was, though, that they didn't follow through with that grand idea. They got to the inevitable conclusion, and we talk about it in the book, and many papers all pointed to that there was a need to introduce a capital gains tax. That was the inevitable conclusion of all those reforms. And in fact, David Cahill in late 1989, he was then the finance minister, introduced a consultative document which said, we're going to tax capital. We need to do this to remove the distortions. But that was never followed through. And the problem was that if you're building a system which is trying to remove all incentives, such as you used to be able to get tax relief for contributing to superannuation schemes. If you're removing a system and trying to remove all the distortions, you have to follow through with it, because if you don't, you basically have your foundations are weakened. And that's the key point that happened in 1988-89, where they didn't follow through. The capital gains tax wasn't put in place, and that meant that a comprehensive capital gains tax we're talking about, that meant that some asset classes are taxed and others aren't. And the biggest single class that isn't taxed automatically whenever a transaction happens, or through what we call an accrual basis, is property. Okay, so just to sort of give us, by comparison, how are other asset classes taxed? Well, interest on
your... It's a big question.
It's a big question, but briefly,
yeah.
Interest on your term deposits is taxed. Bonds, the interest of bonds are taxed. What people don't realise is that bonds and other financial instruments such as forex accounts, term deposits, etc., they all fall within a specific part of the tax regime known as the financial arrangements regime. And that applies automatically. And what it looks at to do is tax the entire economic return over the life you hold that investment. So that means if you hold a bond for 3 years, you'll be taxed on the interest and the capital gain. And usually what happens is that the gain gets taxed at the final point of maturity or disposal. So there's that regime, and that's $500 billion of assets. It also applies, and people don't realise this, to mortgages and foreign currency mortgages. So Inland Revenue constantly surprises people with that. Then you have, and this is now affects the 2.5 million KiwiSaver investors, the Foreign Investment Fund regime and the Portfolio Investment Entity, the PI tax. Now, of the two, the fifth regime, as we call it, the Foreign Investment Fund, taxes investments overseas, in the likes of Apple, for example, on an arising and accrual basis. You're deemed to pay tax on the lesser of 5% of the value you have of that stock, or the actual gains during a year. Now that means that there's a cash flow effect. You're being taxed on income. You're deemed to receive income when you actually haven't received the cash for it.
Okay.
And it also means that part, in some cases all, of the capital gain that may arise on that investment gets taxed. Now, if you want an idea of just how much taxes arises of that, the New Zealand Super Fund is a good example. Last year, in June 2016, it paid over $500 million of tax on profits of $556 million. And that $500 million of tax, most of that just was because of the fifth regime and the fair dividend rate. It's huge.
Right. Okay. And that's right. So that's collecting tax sort of based on two different systems. Okay. We jump back to property now. We have this 2-year bright line test that was implemented in 2015.
Yeah.
What do you think's wrong with this? You think capital gains tax is a good way to go, but what is wrong with what we have now that the government says is sort of doing that job? So that's if you sell a property that isn't your family home within 2 years, you have to pay tax on the profit.
It's rather an arbitrary line, 2 years. Well, tax often has arbitrary division lines, but so much other. If you hold it for more than 2 years, you theoretically could be exempt from that gain. And what the evidence is pointing to is that people have overinvested in the property relative to other assets. And there's two problems from that from an economic perspective, as I see it, is that we are over-leveraged. The IMF report is quite fascinating because it's looking at people's forward debt as a percentage of income, and it's sort of 150% levels in there. So it encourages debt, which means weakens the economy basically, and weakens savings. Too much is invested in one asset class.
Okay, so the capital gains tax that you believe the government sort of quite urgently needs to implement, how would that work? Would the family home still be exempt from it?
That's the curly part for the politicians. Some jurisdictions exempt it. Other jurisdictions, for example, the United States, have a very high threshold. I think it's $250,000 US. In other words, you make a massive gain on it, you get to keep most of it. Others decide that it's tax-free. I'm inclined to go down the American route with a generous exemption. And it should be borne in mind that we're not going to be, if a capital gains tax is brought in, there will be a revaluation. So property owners who've held properties for 40, 50, 60 years aren't going to be taxed on those gains. There will be a rebasing that happens. So they start from the 20 whenever values rather than the historic acquisition costs.
Okay.
So the idea with a tax system is we want to, what's been the hurdle with a capital gains system is trying to separate out these sort of inflationary gains from the non-inflationary gains and just tax the non-inflationary gains.
Sure.
So
that's an important point.
Yeah. So capital gains tax shouldn't be seen as the bogeyman that it's painted as. I mean, if the rest of the world can manage it, and in the time we look at the surveys, several countries have introduced capital gains tax. Australia in '85, Canada in 1972, South Africa in 2001. It's not as if a capital gains tax is a journey into the unknown. The fifth regime is. No one else in the world has the fifth regime.
Okay. So yeah, it's nothing radical here, really.
Yes, basically.
In terms of actually trying to get this to happen, it's a political issue. Nationals said no, it's got the two-line bright line test happening. Labor said that it would extend the bright line test. That's its solution. It's veered away from capital gains tax. We really only have the Green Party, which is advocating for it. What problems do you see with our system that actually prevents this sort of thing from getting on the table?
I think it's the same problem that may be affecting all democracies across the world, is a lack of engagement by the younger generation, because this really affects the younger generations coming through. The ones who don't hold property don't vote, and there is a naturally the older property holding generations do vote.
Yes. Voting
percentages rise in proportion to age, it seems to be the research.
Yes.
So they're naturally not, borrowing a metaphor, the turkeys aren't going to vote for Christmas.
Sure.
But the numbers will change. I mean, the key thing that changes everything, we raise this in the book, is that now 2.5 million people are KiwiSavers. So there's a huge group of people who are now subject to capital gains tax relative to a smaller group of people who are not. And so the demographics, I think, will, at some point, a politician will be able to capture that demographic and say, well, let's just get on with this.
Something else that you mentioned in the book is kind of the way that tax policy is made, and the, I guess, the balance of power or the amount of the ability that the inland revenue has actually to sort of implement changes. Could you just explain to us how you believe that needs to be spread over more players?
The policy, New Zealand tax policy is driven by what we call the generic tax policy process, and this is a sort of set of guidelines as to how policy changes will be implemented. There's a strong emphasis on consulting with the taxpayers and professionals on that, and it is regarded as a world best practice. The problem is it requires active engagement, and for example, for someone like myself as a solo practitioner, if I wasn't such a tax nerd, I wouldn't pay much attention and not be engaged in it. So then it falls to the larger organisations and larger companies and the big law firms, the big accounting firms to get involved. And naturally, if they're representing their clients, it then tends to colour slightly what's happening on that. And so we think that we want to look at the example, follow the example of the Australians who have a taxation board and adopt something similar, but we don't want it captured by the large firms, the technocrats. And so that's why I was saying it's got to have a broader range of membership on there, such as smaller accounting organisations. The Bookkeepers Association is one. The Commission for Financial Responsibility,
yes.
Citizens Advice Bureaus, Consumer New Zealand, for example, organisations that deal with people at a day-to-day level, so that tax affects everybody, but it shouldn't be left to the tax professionals.
Yes.
You want wider engagement. So we feel that this board is one that must represent wider group of people so that tax reforms are actually driven through where it is genuinely being seen as people have had genuine input. The people representing poverty action groups was another one I was thinking of.
Okay, Terry, look, we need to wrap it up there, but thank you so much for your time. This is a great read, and I think a pertinent time ahead, with the election coming up, for us to sort of engage with some of these issues. So I really appreciate your time. I've been joined today by Terry Baucher, and I'm Janae Tibshirani.